Okay, we're going to look at goodwill, and we're going to look at the valuation of the non-controlling interest for goodwill. So here's a very simple balance sheet, parent and subsidiary at date of acquisition. So there's no post-acquisition earnings to consider. It's just how do we share out the goodwill at date of acquisition, depending on different ways of giving the non-controlling interests. And here are a number of ways of stating the non-controlling interest. It can either be valued as a proportion of net assets, net assets being these, of course, the equity, or you could say the the non-controlling interest is valued at or as £9,000. So the directors of the parent company have done some analysis and that is their estimate of the NCI value. Or they could have an estimate for the goodwill from the NCI. Or they may say, well, the market value of the shares of the subsidiary at the date of acquisition was, for example, £4. And then you can work out the goodwill due to the NCI based on that. So let's have a look at these 4 ways of valuing NCI. So number 1, the NCI is valued as a proportion of net assets. So let's just make a note here. Goodwill. So we've got the parent's contribution from parent, and we'll put that as well, we know what that is. It's 30,000. That's going to be common to all these examples. 30,000. So then we can do the NCI contribution. This is the one that's going to change in all these examples. So how much do we put in here? Well, the net assets are 20,000, and the NCI we know has 25% of the ownership. So it's 25% of 2,000, which is of course 15,000. No, it's not. It's 5,000. So this is 20,000 net assets times 25%, 5,000. And let's just make a quick note of what that is. 20,000 times 25%. Okay, so that is the contribution. Then we have the net assets. So the goodwill is the contribution, and then you take away what they've actually bought in terms of hard assets. So we have for shares 10,000, and we have retained earnings. Again, this is all at the date of acquisition. Retained earnings, which was another 10, which gives, if we add all that up, we'll sum the whole lot, gives 15,000 for our goodwill calculation. So that is 30,000 investment in the subsidiary from the parent, 5,000 from the non-controlling interest as their proportion of the net assets, 10,000 in shares, 10,000 retained earnings is what they have both purchased, which gives us goodwill of 15,000. Now, to whom is this goodwill attributable? In fact, in this situation where it's stated as a proportion of net assets, the non-controlling interest have only really purchased a proportion of this. They haven't paid anything over that to cover goodwill. So when it's stated in this way, the goodwill is only attributable to the parent. When we look at the other examples, we will split goodwill between the non-controlling interest and the parent. But in this case, it's all attributable to the parent because the non-controlling interest only paid £5,000 as a 25% share of the net assets, the total equity in the business. So that's goodwill calculation number 1. We can just let's make a little heading there. So goodwill number 2. Goodwill number 2. We start off the same. We can just copy that down. Contribution is 30,000. It's going to be common to them all. Okay, so contribution for the NCI. What does this one say? Well, it says the NCI is valued at £9,000. That was their. Let's just make that clear. The NCI valuation contribution was valued at 9,000, so we can just put that straight in there. It's 9,000 this time. Shares and retained earnings, well, that's going to be the same. They've both purchased the same assets, so we can put that in. We'll just copy that calculation down. I'm going to save a bit of space here. Less shares, less retained earnings. Sorry, it should be negative. Less shares, less retained earnings means there's £19,000 goodwill, and you'll see instantly that of course it's different to the figure above. So £19,000 in goodwill is our total goodwill. And who's this attributable to? Well, it's split, isn't it? It's going to be split in the same proportion as the ownership, 75%, 25%. So we can split this. I'll just make a note here: 25% and 75% and 25%. So that's goodwill number 2. See if we can fit in goodwill number 3 here. That's going to be the same. Contribution, let's just copy that up. So the contribution from the parent, 30,000. It's the same in number 2 and number 1. So what's the NCI valued here? Well, here we have the goodwill amount calculated directly. So we can just do less shares of 10,000, less retained earnings of another 10,000, and now we can do less NCI goodwill. It's given to us as a number, so we can just subtract that from the total amount, and that's going to give us a different sum. Add them all up. So the goodwill in this instance is 3,000. The parent's contribution was 30. They've bought £20,000 worth of assets, which would have given 10,000 in total goodwill. And the NCI's goodwill was 7,000 of that. So our goodwill, or the parent's goodwill in this instance, is 3,000. So again, you can see these are all different. Each one of these is giving a different figure for goodwill. And the last one, market value of shares at date of acquisition, was £4. So we have to do another calculation. Let's just move these up. If I got enough space. Don't think I will. Let's do it here maybe. Move these over slightly. So this is goodwill number 4. Goodwill number 4. We've got the contribution from P. Contribution from P. And the contribution from P was 30,000. We've done that many times. Just open these up slightly, running slightly out of space here. Contribution from P. The market value of the shares at the date of acquisition was £4. So we know how many shares the NCI has purchased. There were 10,000 available. They've got 25% of them, so they've purchased 2,500 shares. So that's going to be 2,000 contribution NCI is 2,500 shares times by £4. And whatever that comes to is going to be their total contribution. It comes to 10,000. So again, we can put in what they have purchased, these two organisations together. They've purchased £10,000 of equity shares, and they have purchased £10,000 retained earnings. Let's just make that negative. Less shares, so there we go, 10,000, and that will give us a goodwill figure attributable to them both, of course, because now the non-controlling interest has paid a market price, 20,000, which we will split 75-25. Again, you'll see that all of these give slightly different figures for goodwill. Just tidy this up a bit. So goodwill in this instance was 20,000. Goodwill in this instance just to the parent, because we had the goodwill given in the question at 7,000. So goodwill to the parent is 3. Number 2, going backwards. Goodwill here in total was 19,000, which will split 75-25. And the goodwill here, the NCI contribution was just given as a proportion of the net assets. So they haven't paid over that value, i.e. they haven't paid any goodwill, so the goodwill is not attributable to them. So it's just to the parent, and that's just in this one case. So let me just see if I can, there we go, squeeze that in. And those are our goodwill calculations. 4 different methods of valuing NCI goodwill. Each one gives a different number, and then we'll use these goodwill figures later on to put into the consolidated statement of financial position. So that's valuing NCI goodwill.